Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. My guest today is Danielle DiMartino Booth, the CEO of QI Intelligence and the author of Fed Up. And Danielle is coming to my conference in Vancouver, the Vancouver Resource Investment Conference, January 19th and 20th, alongside dozens of other keynote speakers like David Rosenberg, Robert Kiyosaki, Dr. Pippa Malmgren, Colonel Douglas McGregor, Grant Williams, dozens more for 2 days in Vancouver, BC, January 19th and 20th. Hit the link right beneath this to check out tickets. And this conversation today was an absolute showstopper. Did you know that the average age of home buyers in the United States is now 56 years old? That's bonkers. Today, we cover the equity market, the commercial real estate market, and the residential market forecast and expectations. Very insightful interview with Danielle DiMartino Booth. Enjoy.
This is Jay Martin.
All right, here I am with Danielle DiMartino Booth. Danielle, it's great to have you back on the program.
It's great to be here. Can't wait to see you in person soon as well.
It's coming up. Yeah, we're like 7 weeks away from the VRIC back in Vancouver. I'm looking forward to that. Glad you're coming back. It's going to be a good one.
I'm excited.
So here's where I want to start today. There's a handful of directions I want to go. Let's begin just looking at the market. Love to get your thoughts on market climate right now. I'm going to attempt to paraphrase you from a recent interview that you did. Hopefully I get it relatively close. You were referencing some data that you recently read that said there's been about 1% of time in the entire existence of the U.S. stock exchange where equities have been this overvalued relative to their underlying assets. Did I capture that correctly? And if I did, would you mind expanding on that a little bit for me?
So that is correct. I mean, in the sense that that market strategists, and I wear another hat as an economist, we often look at the world in a bell curve. And once you're so far out in the tails of distribution and you're saying, geez, there's only one other time in the history of the financial markets, that 1% of other time in the history of the financial markets, it doesn't matter what you're talking about. You're talking about, in that particular reference, it's because the market is 40% more overvalued on a price to sales ratio than it was in 2000. But even on a price to book ratio, it's more overvalued than it was in 2000. In terms of market concentration, that's higher than it was in 1929. I mean, I think, especially when you're starting to see a lot of long-term bulls throw in the towel, it's not so much a recognition of the fact that markets can stay bubbly longer than the investor can stay solvent. I completely understand that, but you're in a surreal reality. Which is an oxymoron, right? You're in surreality when you run out of precedents, when you run out of means by which to compare where we are. And so much of it right now is predicated on the strength of the U.S. consumer. And rightly so. Don't get me wrong, rightly so. It's just, even when you talk about the strength of the U.S. consumer, then you have to talk about a whole nother set of distributions. And then you're once again having a discussion macroeconomically that's in the tails.
So predicated on the strength of the U.S. consumer, you could ask a lot of questions about that when you look at things like rejections of new credit applications, credit card delinquencies, just like a steady sort of curve, for a couple of years now. Doesn't look like it's pointed in the right direction. So pick that apart. Do you think that's where are we lost on that connection between the strength of the consumer, the overvalued equity, and the reality?
So, I was speaking with one of my institutional clients about this today, and I rightly get a lot of pushback because we're in such an unusual situation where we continue to see, whether it's Cyber Monday sales going up. There are several factors at play, and I think you have to take all of them into consideration. One of them is the strength of public sector job growth. And that is something that we know that I think around 56% of jobs in the last year came out of the government sector, healthcare. That's highly, highly, highly unusual. So in addition to unprecedented levels of government support for the job market, public sector job market creation. You also have 40 million or so Americans who really haven't been penalized for not paying their student loans since March of 2020. I mean, at some point you start to say, gee, that's a long time. And, if they say roughly half of U.S. student loan holders are not paying their student loans. So call it 20 million, 20 million.
Sure.
So they have not been reported to a TransUnion or an Experian. They've not been reported to these credit agencies since March of 2020. And they won't, the actual reports won't hit until January of 2025. So by law, they were supposed to start paying their student loans back in November of 2024. They won't get penalized for not having done so until the lack of payment in the fourth quarter of 2024 is reported come January. And we know, backing up a step, that COVID era pandemic funding to states and localities is over. So the strength that we've seen in job creation, the fuel for that is going in the opposite direction. Just south of Vancouver, the state of Washington has put a hiring freeze on, and they've put a freeze on all salaries. So that's new. This is going to add a whole new wrinkle in 2025. In addition to that, you're going to be penalized for not paying your student loans. In addition to that, you've got the Federal Reserve anticipated to take interest rates down an aggregate, a cumulative 100 basis points by the December the 18th FOMC meeting. So one of the pillars of strength of U.S. consumption, 70% of U.S. GDP. It's an enormous, I want to say it's 17 or 1718 percentage of global GDP. But one of the huge supports has been interest income because people have been collecting 5% on their cash just for sitting on the sidelines and just watching the markets go by if they're not up to their eyeballs in NVIDIA or Bitcoin. Well, that is coming off as we head into 2025. And one last thing I'll add, and again, this was a long drawn out discussion I had with one of our institutional clients this morning, and that is buy now, pay later. And buy now, pay later really didn't exist the last time the U.S. went into recession. When a poll was recently run, what are you going to be spending over the holidays? If somebody is going to be financing their holidays on credit card spending, which has gone bananas, they were planning on spending, rough numbers here, $1,600 over the holidays.
Yeah.
If somebody was going to be using buy now, pay later, their holiday budget was closer to $1,900.
Interesting.
And the reason I bring this up is because buy now, pay later is not incorporated into your credit report. It's not reported to the banks. It's not reported to the credit agencies. It's completely outside of if you were going to apply for an auto loan or refinance your mortgage or get a new credit card. Whatever you're spending in buy now, pay later, it doesn't show up. So you look like you're a lot better credit than you actually are. And yet, even with buy now, pay later, you're planning on spending more. We don't know we don't know what the flip side of this looks like. And sorry, there's a fifth element here, and that's the gig economy.
Okay.
So Uber was born in 2009 in Paris. The last time we went into recession, true recession in 2007, it didn't exist. So all of the full-time jobs that have been lost in the last 12 months in the United States, 1.4 million jobs, full-time jobs have been lost in the United States in the last 12 months. That's a decent sized number. They've largely been absorbed by a gig economy that didn't exist. Does that mean that the incomes are not real? No. You can't discount somebody who's making $750 a week driving for Uber or Lyft. It's a real buffer to their income, but you're also, by the same token, starting to hear, now that we're pushing 10 million Uber drivers alone in the United States, now you're starting to hear people say, I need to get a new gig to back up my gig. Because there's too many people who have fallen into this gig economy.
Sure.
as regular layoffs in the private sector continue to blow and go, which we've seen in revisions that are nothing like we have precedent for. In the year that ended June 30, 2024, one revision told us that there were actually 1.2 million fewer jobs created than we had anticipated. So
Yeah.
when you're cutting job growth in half in the private sector, these are real numbers. The reason I bring all this up is going into 2025, there are a lot of ticking time bombs and a lot of sources of support for consumer spending that drives the world's largest economy that are impaired.
You know, I might not have made that correlation, but it makes absolute sense. Losing 1.4 million jobs in the last 2 months directly correlated to the oversaturation of Uber drivers. People got to seek out that hobby income, make it the full-time income, or increase the supplementation, whatever that looks like. And eventually, you got more drivers than you need. And as many jobs as we lost, I mean, those that have been gained have largely been public sector jobs, as you discussed. What do you think the impact of the Department of Government Efficiency will really have? Do you think they're going to be able to make a dent? And if so, you'd assume it's only going to contribute to worse jobs numbers in the near term, at least.
Right. And that's why it's funny you bring this up, because in my Bloomberg chat room today, I asked my institutional clients, I'm like, what are the odds that Donald Trump is committing infanticide? I'm using the wrong word, when you kill a child.
Yeah. Okay.
But what are the odds that he's killing Doge? And pretty quickly, because this massive source of support for the U.S. economy, and he tends to ascribe his value as a president to the stock market. If you hear an increasing number of companies, and a lot of companies during the third quarter earnings season were saying, we're not missing on our bottom line, but we sure are missing on our top line. So what if one of the biggest sources of revenue for companies, which is you get the highest pay for the lowest level of education in a government job, what happens if that pillar of support starts to teeter if Musk is remotely successful? And is Trump going to stand by and let that happen, as well as it campaigns with the average American to cut the waste, cut the waste, cut the waste? What happens when that starts to manifest in a greater number of companies missing their revenue targets going forward? Because the private sector job market has not recovered. You're hearing huge amounts of confidence in the future. I mean, you've seen a complete flip. You've got most Republicans in the United States saying, we see a pathway to sustainable private sector growth in the United States. A lot of the soft surveys are very optimistic, but you're not hearing CFOs or CEOs or small business bankruptcies, for example. You're not seeing any of the bloodletting stop. You're still seeing cost cutting going on, factories being closed, small businesses going bankrupt. You're still seeing it. So you have to cross the bridge between enthusiasm for the future and delivering on that enthusiasm by increasing your hiring, because your top line growth is accelerating. And we're not there.
And if we don't get there, if there's no top line acceleration, there's no new job creation, and this engine doesn't get restarted, do you think there's a glut of bad news that maybe, if you're in a position of power, you can manipulate the data to an extent, right? Do you think there's a glut of bad news that we're probably going to get on the heels of a changing of establishment, when sort of the rug gets pulled and the curtains open up and here's what the economy really looks like?
So here's an arcane reference. So the Bureau of Labor Statistics, it resets its birth-death model that's imputed, a third, 40% of job creation over the last year or so. But it resets its birth-death model every 5 years.
Okay.
So the last time this happened was 2019, when the U.S. economy was pre-pandemic and prior to the bankruptcy cycle. Now they're going to reset it 5 years later, and it's going to reveal a lot less in the way of births, because we know that the bankruptcy cycle, according to Standard & Poor's, they put out a report today that said bankruptcies are running at the highest level in 14 years. That takes us back to the great financial crisis. So we know when the BLS looks to reset the pace at which companies have been being born and the pace at which companies have been dying, that it's going to be a lot less flattering of a plug factor month in and month out for the next 5 years when they're reporting non-farm payrolls every Friday. So rather than have the numbers skewed to the positive, and then you wait until you get these annual revisions, and then you wash all of the plug factor that was positive out, and you say, oh, gee, in the last year, the private sector actually created 1.2 million fewer jobs in the last 12 months. Instead, we're going to start to see more quickly realistic job numbers. And we've got some massive revisions coming up in the first quarter of 2025. And there'll be all manner of people screaming to the hilltops, gee, you know, these left-leaning bureaucrats in Washington, D.C. have released the Kraken. And they're letting the data finally fly that we know they were hiding during the election season. Mm-hmm. So be it. If that is how it's perceived, that won't make a difference if the average American is all of a sudden seeing, instead of the unemployment rate with a 4% handle, a 5% handle. Mm-hmm. That's a bit of a reality check.
And if it is, you could logically say this has got to impact the equity market. But I mean, that logic's been wrong for a long time. So the decoupling's pretty real. What's your take on a incredibly overvalued equity market in that economic environment?
It's been enormous. And, you know, it hasn't hurt at all that this administration is all over cryptocurrency. I mean, you can't have a greater validation for keeping the animal spirits alive than have the government itself come out and say, we're going to start a strategic reserve and buy it up. Because whenever the government's buying something, they're price agnostic buyers. There's no better buyer in the world, whether it's the Federal Reserve buying treasuries or mortgage-backed securities in the open market, and they don't care what the price is because they're running a quantitative easing program, or whether it's Uncle Sam buying Bitcoin. That won't change, though, the reality check of a true increase in the unemployment rate. The unemployment rate in November was reported as 4.246. So that's a matter of 7,100 jobs in a workforce of 180 million. So if it was 7,100 more jobs that were calculated into the unemployment rate, it would have been 4.3%, which matches the high, which is 0.8 percentage points off of its lows. U.S. has never not been in recession with that kind of a move off the lows of 3.4% to 4.3%. And we're effectively at 4.3%.
Right.
So you keep going up with this, and the stock market won't have a choice but things in 2024 have been, it was an election year, and things have been as slow as molasses in January, or if you want to look at it as oil in the tar sands in January, moving real slow. And that's how the unemployment rate has been rising, but we don't see any reason for the increase to not keep going in 2025, given the number of business closures, bankruptcies, and to say nothing of mergers and acquisitions. M&A is a really polite way of saying we're going to put together two huge companies and fire a big chunk in the middle so that we can realize synergies.
Yeah.
Whatever it is that all the consultants are paid too much money to create when they suggest an M&A.
Okay, so just because you mentioned it, the strategic Bitcoin reserve, I'm really curious. Is this signaling to win the popular vote and nothing more? Or do you think there's some substance to in investment in a strategic Bitcoin reserve moving forward for the American establishment?
Well, I mean, math is math. It doesn't matter if it's not a store of value or medium of exchange. If the government's buying it, the government's buying it.
Okay. So
if all you're talking about is the price of Bitcoin, if you have a bidder who doesn't care what the price is, price go up. It's just pretty simple math. So, the question is, are there people who are going to be selling alongside this and taking advantage of a buyer that is blind? I don't know. But what I do know is that the government sanctioning something is not going to all of a sudden overnight turn it into something that's to turn it into a medium of exchange or a true store of value. That's not a magic wand that anybody can wave. There has to be practical, real world use, not adoption, not ownership, but use. And we just saw in Nicaragua that the IMF, in order to provide the country with sufficient bailout, made the country back away from Bitcoin as a prerequisite. So
Right.
again, adoption is not the same thing as use. And I think that that's where the question remains to be answered.
Yeah, fair. Okay. Makes sense to me. I want to pivot a little bit to, do you watch the commercial real estate market much right now? And like 13% vacancy, I think, in the United States right now. But one of the hottest stocks of the last few months this year has been SL Green, which is the largest owner of New York City office space. Now, maybe they're an outlier because they own, ultra high end, like One Vanderbilt building, for example, right, which is now at full occupancy, super high end. But what's your take on commercial real estate exposure? It was a big part of the conversation 9 months ago.
That's by the way, that's the original Bear Stearns building, by the way.
I didn't know that. One Vanderbilt, right? Okay.
I think
Interesting.
Trump has said he's not going to fire Powell. And why would I answer a question about commercial real estate by saying Trump has said he's not going to fire Powell?
Mm-hmm.
Well, a more progressive type of Fed chair might be amenable with a really progressive Treasury secretary to potentially craft a bailout of the commercial real estate market. Barring that, and I don't think you get that with Jay Powell.
Okay.
At all. But barring that, we know from TREP data that office delinquencies are now north of 10%, and that the delinquency rate appears to be headed to the highest on record. We know from one retailer
This is delinquent rent payments. Is that what this is?
Delinquent on the office property mortgage.
Okay, got it.
So delinquent on the loan.
Yeah.
And we know that phenomena is not isolated to the office sector anymore. We're seeing quite rapid pickups in, not in any particular order, lodging, multifamily, retail. Appreciable pickups in these areas. So, the only kind of last bastion of strength has been data centers, has been industrial. But by the same token, we're seeing a lot of companies follow in Walmart's footprint of saying, rather than distribute through a warehouse, which is expensive, I'm going to follow the Walmart method and just distribute out my back door of the closest store. And that way I save on warehouse space. What I'm trying to say is that's one of the biggest areas that has been one of the greatest areas of growth in commercial real estate. Now it looks like it too is overbuilt. So what I've been telling my commercial real estate clients, because this is something I write about with probably second greatest frequency after monetary policy. What I've been telling my commercial real estate clients is you trade for the dirt. You're absolutely agnostic to what the building is. If it's not an SL Green, One Vanderbilt, A+++ building that can do your laundry on the way up to your office in the elevator for you and whatever else you need for the building to do, if it's not a state-of-the-art smart building, and these are smart buildings we're talking about, that are commanding rents. And here in Dallas, Texas, where I sit today, there are 7 large office properties being built on one side of the main highway that goes through downtown Dallas. And there's a lot of empty buildings on the other side. So what I continue to tell my commercial real estate clients is trade for the value of the dirt underneath the building, whether it's a mall that's no longer occupied or a hotel that's no longer sought after, or an office building that is that's not an A+ office building that's not part of the 1.9% that can be economically converted to multifamily or a hotel. Trade for the value of the dirt underneath it.
Yeah, interesting. Okay. Do you make much of this office to residential conversion trend? And I don't even know if you'd call it a trend yet, but there's
again, it's 1.9%. That's what we've seen after a sizable run up of conversions. So it used to be closer to 1%. Now it's closer to 1.9% because there have been so many communities who have encouraged developers to push forward with these conversions. But even so, even with a little bit of subsidization from the public sector, we've still only seen that pick up to 1.9%. The reality is a lot of these A, B office buildings only have one silo of plumbing that goes up the center of the building, and nobody wants to live in an apartment with no windows. So they can't economically be converted, so they're not being converted.
Yeah. It seems to be the older buildings that are getting more narrow buildings, smaller floor plans, all of this. So these are office buildings that are being repurposed as residential. Obviously, requires a massive overhaul and construction.
Well, like the Flatiron building in New York City, that's going to be converted to apartments. That's a pre-war building.
Yeah, pre-war.
Yeah, and you can go there, especially when the location of the property is as prime as the Flatiron building. Of course, you can make that happen, but that tends to be the exception, not the rule. Or we'd have seen at least a breaching of the 2% conversion rate, but we're not. We're still talking about 1 point something here.
Okay. I think the average age of home buyers in the U.S. is now around 50. You find
56.
56, the average age of home buyer. That's bonkers. Okay, I got some questions to spin out of that, but first of all, what do you make of that stat?
Well, it's depressing. I was reading a story yesterday about how to not let your children who move back in with you, eat away at your retirement savings, and methods for being a tougher parent when you've got your adult child moving back in with you, because they can't afford to be out on their own, or because they lose their full-time job and they can only afford so much with what they're making at driving for Uber. So they've got to move back in with mom and dad. The phenomenon is very real, and it's problematic because economic cycles feed off of themselves when young couples get married and have kids. It's just the cycle of life. You start out in an apartment, and then you save up your 20% down, and then you buy your first home, and then you end up going, oops, we had a third kid, and then you've got to move up to a bigger house. But these are all cycles, and they feed consumption of nurseries, and then, toddler beds and diapers. Again, it's a 70% consumption. 70% of GDP is consumption. But if you arrest these natural demographic trends, because an entity like the Federal Reserve at its peak owned 39% of the mortgage-backed securities market, and you end up with artificially high home prices, you got a problem on your hands. And that's why you have so many multi-generational households being formed in the United States that are specifically being designed so that mom and dad in their retirement years, they've got a nice little kitchenette in the basement, so they don't have to deal with the kids on the top floor being in a diaper that needs to be changed. But this hasn't typically been what we call the American way.
Right.
The American way is you grow up, you get a job, apartment, starter home, move up home. And that's clearly not the case. And in fact, you're seeing a very high percentage of homes not just be multi-generational in formation because your adult children are moving back in with parents, but also the flip side of that, because healthcare is so crazy expensive in the United States, whatever it is, $12,500 per capita compared to $6,100 in other developed economies, including Canada. But because healthcare is so expensive and the social safety net for long-term care is so fragile and weak, we're also seeing 20% of multi-generational household formation result from parents being forced to move back in with their adult children. So the flip side is also very much at hand, because nursing homes and long-term care and assisted care facilities in the United States are prohibitively expensive. I'm watching it with my best friend from growing up. We've been best friends since we were 13. It's not easy to fork out $10,000 a month for subpar care.
No. I mean, part of me wonders if there's almost a silver lining to that scenario. And I don't mean to downplay the negative impact of not being able to afford a home. I mean, having to, multi-generation in one house, but it's not the American way. You're absolutely right. It hasn't been the American way, but there's also a downside to kids living so far from their parents. I mean, there's a sort of a fracturing of community that we've also experienced since like the 40, 50s,
They, look, I'm Italian, and I'm a full believer. And in fact, I'm a career woman with 4 kids. Mm-hmm. Had my mom not been close enough by proximity wise, geographically speaking, I would have had to have altered my career, slowed my career path. It was, but for the sake of my mom being close, that I had the freedom that I did and the flexibility that I did on a professional level.
Right.
And I'm all over with the cost of childcare in the United States gone wild. Yes, use the resources. I mean, my mom just turned 78 years old. She ain't planning on going anywhere anytime soon. Mm-hmm. So the silver lining is absolutely being able to, even if you're talking about something as fundamental as having another child, we're talking about a human being here. Mm-hmm. But, if you've got your parents close by and that support network, then maybe you can go from being a 1 to a 2 kid home or a 2 to a 3 kid home because you're able to do so because you've got that support. I'm all over that, but I'm Italian, but that's not going to help the U.S. economy.
Yeah. I'm with you there. Could help the housing market. I mean, the number of like single resident households has gone up a crazy amount in the last 40 years, as well as people living alone is a new trend in the last 40, 50 years. And this depletes.
Absolutely. And that is actually one of the solutions, if you will, to the trend that we saw from 2000 and really in the 2000s, 2000 to 2010, the trend of seeing these massive McMansions being constructed. And now you've got, grandma and grandpa living in them, right. How to fill them up, you move in the family.
Yeah. Okay. So there's another trend kind of on the heels of housing inaffordability, which is the build to rent model. And this is getting a lot of action from private equity and real estate investment firms. I was just looking at a development in Bee Cave, just outside of Austin, not too far in Texas, far from where you are.
Exactly where it is.
Yeah, you know it. So that was a $50 million development that I think resulted in like 186 townhomes. But there's, billions being invested into these build to rent projects.
My niece and her husband with their 14-month-old live in one right outside of Austin. I know exactly what you're talking about.
Yeah. So this is being called by some in that industry like a brand new asset class. That's how real this is going to become. What's your take?
Well, if only the studs were to spec, if only the studs were to code.
Okay.
And the reason I give you pushback is because we are seeing that the lifespan of a lot of these homes is not what we would think it would otherwise be, because they are cutting corners when they build these homes. And I wouldn't know this unless my niece's husband was a general contractor. And he saw that the studs were 24 inches apart as opposed to code, which is 18 in this build to rent home. So we're not seeing the longevity of the properties. And by the same token, you're also seeing that the rents for these homes are certainly higher than they would be for an apartment. And then you get down to who can afford to rent them, because it sounds to me like they're white collar workers.
Okay.
And that brings us back to what started this whole discussion. And that is, what is the capacity of the U.S. private sector to restart the hiring engine that thereby supports what the investment bankers will happily tell you is the future for these new asset classes. But we're actually seeing invitation homes. We're seeing a lot of these publicly traded companies announce with their earnings that they're having a very, very hard time increasing rents, unlike 18 months ago, 24 months ago.
Interesting. Okay. So the interesting comment on the rents. I understood this asset class is like, this is, if you can forego participating in home equity, this is a way you can get into that 4-bedroom home in a community with maybe community amenities like pools and gyms and and centers and all that stuff.
Close to good schools. That's the biggest selling point.
Close to good schools. Yeah, exactly. Near the tier 1 school districts for a fraction of the price. You don't get to participate in the equity, but you get the lifestyle. You get the household. What?
Yeah, but it's the fraction of the price part that kind of falls apart because you end up being so close to what a mortgage payment would be that you end up becoming trapped.
Yeah.
So there's never the ability that there was in the 80s and the 90s to rent an apartment when you're newly married and have enough left over from paying that rent to save up the 20% down payment to eventually buy a home of your own. You end up being an effective indentured servant.
So what's your forecast then on this trend? Because, you've clearly blown some holes in the thesis that this is just a brand new asset class and it's the solution, right, to those that can't afford a home. There's actually a lot of problems with that thesis. Simultaneously, housing is still unaffordable and out of reach for most. And for most people, it's a very frustrating scenario because the home they couldn't afford last year is far less affordable this year. And it's just continually out of reach. So, what if you were to project this build to rent industry into the future, do you think it's got some growing pains to sort out and then it has legs, or what's your take? And is it a positive outcome? I mean, the dystopian future would be like, 50% of the U.S. housing supply is owned by, a dozen private equity firms. And that's not a scenario that anybody wants. But what do you think?
Nope. I'm not one who's a cheerleader for this new asset class by any stretch. And I think it's realistic for us to have this conversation 12 months from now because of 3 very big hurricanes that came plowing through an area of the country that comprised 100,000 plus single family rentals, which is a different asset class, technically speaking. But I think 4% of them had flood insurance, where Hurricanes Beryl and Helene and Milton plowed a trail, but they happened to be cities in the United States where a lot of money had come from the East Coast and the West Coast to buy up these investment properties and thereby rent them out on a weekly basis and support the mortgages that way. And, people who advertise on the radio, you too are going to be a landlord and a multi-zillionaire, and you can get into this racket and easily so. Now we see the delinquency rates where these 3 hurricanes hit going bananas. And a year from now, when we've had this inventory put back onto the market and clear hands, I think then we can have a discussion about build to rent.
Yeah.
Because there's been so much inventory that's been held off the market by way of investors buying it that is also appropriate for the same family to potentially buy. And you're seeing my good friend Ivy Zellman, she's a housing expert. You are seeing continued home builder buy downs of rates to get people into the homes. You've got the highest inventory of completed spec homes since 2009 on the market. Home builders have to sell these homes. So a lot of potential build to rent renters are actually finding that they're able to, using a buy down of the mortgage rate from the home builder, that they're actually able to buy the home. And that inventory is going to be competing with these Airbnb jocks, as I call them, these investors who begin to liquidate their portfolios. So I don't think anybody can say with certainty, going back to whether or not, if the private sector job creation engine gets restarted, then all of this excess inventory, the spec homes, the investors dumping their homes, it'll all get absorbed. If it doesn't, we're going to have a little bit more price discovery. And that's why we're seeing delinquencies rise where these hurricanes barreled a trail, and delinquencies being at untenably high levels typically leads to home prices falling. That's good news. By the way, this is all good news.
Why?
Well, you don't want to have an indentured. I don't want your dystopian future.
Yeah. Neither do I.
I'd rather have the youngins buy the home.
Yeah.
And buy the home at a lower price and actually be able to. I'm all over the silver lining of if these 3 hurricanes washed a bunch of investors out of the woodwork, and because they didn't have adequate insurance to repair their homes and therefore had to sell them, fine. Goodbye.
Yeah.
Don't let the door hit your on the way out. So I don't mind that at all, because especially cities like, talk about anything in Asheville, North Carolina, a gigantic chunk of Florida, Houston, Dallas, San Antonio, Austin, you've got a lot of empty homes. And empty homes don't do an economy any good.
Mm-hmm.
They don't do an economy any good just because sellers are holding out. No, that doesn't do anybody any good. Get them through the market, bring the prices down, allow for price discovery to happen, and get these young couples in new homes and owning them with a mortgage instead of renting them with never a hope in hell of being able to save up a down payment because they're spending so much in rent to be in that right school district with a pool down the street.
So if you were speaking to somebody in their, say, early 30s, or it doesn't matter, they're looking to buy a family home in the U.S. right now. Mm-hmm. Talk to me about what you may suggest in terms of timing and location by state. I mean, and there's no federal real estate market. It's regional, right? So
regional.
Any thoughts you have on a region or state, and then any thoughts you have on now versus in a year timing?
So, I think now is a time, especially if you're, as you described, in your early 30s, now is the time to be as flexible as your budget will permit in terms of location. Mm-hmm. Because if you can go to where the excess inventory is, and if you're young enough in your career that you can say, you know what, I'm young enough, I can start over. And you can find work wherever there's an excess of inventory, then the math is going to benefit you. Unless we're talking about, a home on Nob Hill in San Francisco that may never be affordable.
Right.
Or an apartment in Manhattan. But I'm talking about flexibility in terms of where these investors are going to be dumping the homes, and which that's the Sun Belt, and whether you can find a job there. That's my advice, is to just be as agnostic as you can about the location, or consider moving in with your family. Think about being Italian a little bit. Yeah. Do whatever you can, because I think when I talk about buy now, pay later, and people spending more money because they have access to buy now, pay later, and getting further and further into debt just so that they can live for the day, that's not a formula for long-term happiness and building a family. And I mean, people ask me all the time, what's your life's greatest accomplishments? And I'm like, William, Henry, Carolyn, and John Jr. I mean, that's it. So understand that look over the horizon, be as flexible as you can, whether you're talking about living with your family or moving and relocating to go where the home inventory is so that you can get the best possible deal.
Yeah. And the Sun Belt is where you might start looking right away in terms of abundance of inventory that's got to get put on the market at some point. I
mean, these are investor homes, and these investors, like I said, only 4% of them were insured for floods.
Right.
So
yeah,
something's got to fix these homes.
Sure. Okay. Last bucket I want to jump into with you. We were kind of joking about this before I hit record, but President Trump and Prime Minister Trudeau had a dinner together, and the conversation from that dinner has been spread online in a very humorous way. I think it's funny anyways. As a Canadian, I kind of like that the president's poking fun at our prime minister. Canada being the 51st state, or we stop subsidizing you. What's your take on these statements? Very Trump, right? Let's start.
It's extremely Trump. Poke the bear, poke the bear, poke the bear. That's what he likes to do. And he was poking the bear specifically to say, don't mess with me and the tariffs that I'm threatening. Mm-hmm. And, before we started recording, I was just saying that the Nanos weekly confidence survey, Canadians' views of the housing market are awful, and getting worse. The inventory that's on the market in Toronto it's the stuff of international news at this point. Without even discussing the dinner at Mar-a-Lago, before we even go there, I think that we have to first tackle the fact that Canada avoided a balance sheet recession in 2007, 8, and 9. They're not avoiding it this time.
No.
So balance sheet recessions take a very long time to play out while households repair their balance sheet. That's a time-consuming process. And the fact that we're having this discussion, the fact that the unemployment rate is going up in Canada, people are losing their jobs. We are talking about 50 basis point rate cuts out of the Bank of Canada to try and support the economy. When you're having these types of discussions, the last thing you can do to a resource-rich country is impose tariffs. Because then you've got a balance sheet recession that becomes something worse that I can't define, and I'm an economist. So I think if there is a leadership vacuum in Canada, it needs to be rectified. Because just like Mexico and closing its doors to modernizing its energy sector under AMLO's rule, that was devastating for the Mexican economy, when Mexico could have taken the opportunity of the 2018 trade war to build massive supply chains with the United States. And that was largely squandered. Don't get me wrong, Mexico's the United States' largest trading partner, but it could have been so much more, rather than U.S. manufacturers saying, fine, we throw up our hands. We're not getting a warm reception in Mexico. We'll move that factory from China to Vietnam. Mm-hmm. That was an opportunity that was squandered. For heaven's sake, don't let Canada go the same direction. Mm. That would be a complete disaster. And, we've now got the opportunity to build the pipeline, finish it. And all of that needs to be capitalized. And by the way, now, not next year, not theoretically, not in 1 year. Inauguration day is January the 15th. Once Trump's appointees out of the U.S. House of Representatives move into the administration, Mike Johnson's House of Representatives can only lose one vote, before the House is tied 216 to 216. So the margin of the majority is absolutely razor thin, and the Democrats have every intention a year from now, when they break for the holiday season, that's going to be the green light to start campaigning for the midterms. Yeah. So whatever is going to happen to fortify and strengthen trade ties between the United States and Canada, it's got to happen in the next 12 months, or at least the bulk of it that can't be unwound.
Interesting.
So it's a now thing. It's not a theoretical thing. It's right now.
Yeah. And you touched on something that I think a lot of Canadians don't realize, is that we didn't get hit in 2008, right? Mm-hmm. We saw it south of the border, kind of felt like it happened to us, but it didn't, right? We came through with a healthier balance sheet than any G7 nation at that time, right?
And the Chinese just kept on plowing more and more and more money from offshore into the Canadian economy. Yeah. You didn't have an immigration crisis like we did in the United States. Now you do, but for an opposite reason. You went too far. Pendulums always swing too far. Mm-hmm. Now there are too many people in Canada who have moved there from other countries who cannot afford anything in terms of what it costs to live in Canada. So the immigration trend went too far in Canada. But yes, you avoided that balance sheet recession. You're not going to avoid it now.
No, we're far over our skis. It's a very different country than it was, when Mr. Harper was running it, right? A very different leadership style. As mentioned before I hit record, Canada needs a deal maker. That's it, right? It's a massive country with very few people in it. It's, but we're commodity rich, we're resource rich. So getting product to market needs to be the focus for the federal leadership. And the federal leader just needs to clear the path for the provincial leaders to get business done. Mm-hmm. And that's been...
That is what we call long-term prosperity, and planning for it and leading for long-term prosperity, because, it's fun to joke about the 51st state, but if I'm a proud Canadian, the joke wears thin pretty quickly, given all these resources that you have to tap. Yeah.
Well, that's it.
And we're talking about lumber prices as well. I mean, think about timber in Canada, for God's sake. It's not just oil. I mean, there's so much more.
There's definitely. And in terms of being the bear that's getting poked, honestly, I welcome it, because I think the country needs a bit of a wake up call. And yes, the joke can wear thin very quickly, but also it's important that it's heard, right? And that this is the way Canada is being presented right now, with our current leadership. We are due for an election inside of 12 months. We need that change to occur.
Yeah, I mean, it's very much a known in the United States. Your average working Joe and Jane know that there's a leadership vacuum in Canada.
Right.
That's how bad it is.
Yeah.
Because, I mean, when Harper was running the show, I never thought about him.
Right.
But we know that Trudeau is universally disliked and is not done what needs to, he's not the leadership that Canada needs.
No. And you were at my conference in January when Prime Minister Harper was there, I believe, right? That was like 2002, I think. Yeah.
Yep.
Yeah. He's not able to make it back this year, but he's more involved than ever in the Conservative Party of Canada. I mean, since he left office, he's not been involved at all in any of the previous opposition leaders until Mr. Poilievre is now the opposition leader, and Mr. Harper's very involved in the party again, which to me is like it's a vote of confidence because he has, he did steer the ship through the GFC and did it very well. But anyhow,
we need more of that, don't we?
We need more of that. All right.
At a higher level, we also need that for the United States. We need somebody who's strong enough to not kill the baby, to not kill off Doge, even though you could be talking about a more severe recession in the United States than it would be otherwise. And that's going to be a hard pill to swallow. But for the long-term prosperity of the United States, we do need a Department of Education that actually works for our children. COVID demonstrated to us that the current public education in the United States does not work for the children. There are some radical things that can be done that will make a huge difference over the long term, but it's going to be ugly. And Trump's going to have to take that lump. We will see.
Now, do you think because he's not running for, a second term in theory, this is his second term. And so, there's less reason to pump the brakes on some of these big decisions. When you look at his appointments thus far, when you consider that he has the House, the Senate, the popular vote, he doesn't need to win another term, so he can go for broke in theory. What's your optimism level that he will charge forward as hard as he campaigned?
You're asking me what the probability is that Donald Trump is going to enter the White House without his ego.
I guess I am. Yeah.
That's a pretty difficult question to answer.
Yeah.
And I can just say that some of the appointments that he's made, from his chief of staff to the Treasury Secretary, have been rational, and they are people in high-ranked positions. Rubio to Secretary of State. There are some things that he's done that very well demonstrate that he's a much more mature person, a much more mature leader than he was in 2016. So I'm not discounting the prospects for him succeeding. I want for him to succeed, but he's going to have to really be the bigger man, leave the ego aside for the sake of the American people, which will actually restore his legacy.
But inadvertently, he's got to take it on the chin first, probably, and deliver a bunch of bad news, embrace some pain, hopefully come out the other side clean, but that's a maybe.
Yep.
And that's a big ask.
Because again, the bureaucrats are left leaning, and they're they have no desire to be in the crosshairs of Doge. So when you consider that everybody in the Bureau of Labor Statistics, I would say 90% of them are Democrats. If they're going to play defense, they're going to play defense with the data.
Interesting. Look, Danielle, it's always a pleasure having you on the show. I appreciate your time today. Thank you for coming on. And I'm looking forward to having you in Vancouver in 6.5 short weeks, January 19th.
I can't think about that right now because that's like a next year thing. And I've got to go through the holidays first. So don't say I'll see you next year, because that's like, whoa, I have not finished Christmas shopping. However, I'm looking most forward as well.
Yeah, it's all I'm thinking about right now. We got 6 weeks out. We're go. But I'm looking forward to having you back. It's going to be a banger of an event. Attendance is looking very strong. So packed house, and I'm excited for it. Really excited to have you back joining us on stage at the VRIC. Thanks so much for your time today. And if I don't chat to you before I see you, have a lovely holiday.
Likewise.